Okay, so here is a very interesting update on long-term trends. This is a website and this is an email update that I received. So basically, instead of looking on the short term, we look here at ratios in between things. And this would give us the ability to tell if one kind of thing outperforms another kind of thing. Okay, so let's go through this email update and see what it's saying. So basically, it's saying that, of course, we know we have the inflation in the US, which have reached 8.54%. And this is following an increase of the M2 money supply. In a minute, we'll say what is M2 money supply of 26 or 20, almost 27% year over year. So the amount of money has increased in the US in 27%, and now the inflation is following behind with 8.5%. What is M2 money supply? M1 is all the immediate cash like deposits, currency. This is M1. This is why it's called M1. M2 adds to it savings and some shares on retail. So it's a little bit on top of the M1 with additional savings. So this is the M2 is the one that they're saying here that was increased by 26%. So the real interest rate for 1 year US Treasury bonds has dropped to -7%. What does it mean, -7%? This basically means that if we take the interest rate minus the inflation, okay, because you are being paid interest minus the inflation, then reach a negative because the inflation is high and the interest is low. Low minus high is negative. The PE ratio, the price earning ratio of the SP 500 is dropped to 20, which is much better than before. Basically, the higher this number is, the PE ratio, this means that the price you are paying for a stock, or in this case for the whole SP 500, is much higher than their earnings, and it's expected with 20 years of earnings, if their earnings are the same, the revenues are the same for 20 years, to get back your investment. Let's view a few graphs. So here we see the increase in the M2 money supply. You see here this major spike of 20 something percent, and here we see the inflation is beginning to follow the M2 money supply. We see that they have dropped the major increase that they had during the COVID for the M2 money supply. Here we see another indicator of copper to gold versus the interest rate. So we see that the copper to gold is breaking the interest rate, and this is a leading indicator, and there is another leading indicator here for a predictor of economic recession. In general, when we have an environment of rising yields, we have a fall in the bond prices, which are declining along with stocks, and the growth stocks those are the small companies that are expected to grow with a higher pace, are declining more than the value stocks, which are more stable stocks like Coca-Cola, etc., because they have earnings that lie more in the future. So they underperform the SP 500 Nasdaq because it includes the growth stocks. In terms of sectors, then technology sector is going down. Energy is actually outperforming, going even not necessarily going higher, but outperforming the technology. If in the past the technology was overperforming the energy, the basic materials and the utilities, when we have had an environment of low interest rate, now that we have an environment of high interest rate, we have the energy, the basic materials and the utilities outperforming the technology sector. Okay, let's look at a few more ratios. We have here the growth to value stocks. So of course the growth stocks are underperforming the value stocks. The value stocks are the more stable. The growth stocks require lower interest rates. We have the SP 500 versus the total bond. Both of them are going down. We have here the Nasdaq versus the SP 500. We said that Nasdaq has more growth stocks, so it's going down. We have here the ratio in between the technology and the SP 500. Technology is going down versus the SP 500, underperforming. Telecommunication also underperforming the SP 500. Energy outperforming the SP 500, because in an inflationary environment, the energy they gain more revenues in general, so they outperform the market. Also, other markets, no, it was not concentrated to the US. Other markets, such as emerging markets, India, China, Russia, Japanese is not emerging. Okay, but all of them were falling. Japanese minus 23%, Russia due to the war minus 54%, and general DAX minus 19%. This is Europe. And so overall, we see here the emerging markets also falling behind. We see Europe also going down. We see Asia also in general going down, and Europe also also going down. So this was the overall market estimation given to us by Long-Term Trends. I really recommend this site. You can also register to its email updates.